Good morning, everyone, and welcome to another installment of the Prosperity Through Multifamily Real Estate Investing Podcast. I am your host, Real Estate Cody, and with me, as always, the one and only coffee connoisseur himself, Mr. Brian Alfaro. What's up, bud?
What's up, Cody? Nice to see you.
Nice to see you as well. It's a gorgeous day. We've got a lot of great things going on. We have another fantastic friend of the show, guest on the show that's joining us again today. So look forward to that conversation. Why don't you tell us who that is?
All right. Today we have returning to the show our good friend from Invictus Capital, Anthony Vicino. Anthony is a best-selling author, investor, and entrepreneur. He's built multiple successful businesses from the ground up by creating systems at scale and by never losing sight of end user satisfaction. I can't talk today. After years of managing a personal portfolio of multifamily assets spread across the country, Anthony joined forces with Dan Krueger in 2019 to launch Invictus Capital and execute their first syndication. Together, Anthony and Dan are helping busy professionals passively invest in multifamily properties based in the Twin Cities in an environment of trust, transparency, and clarity. Anthony, welcome back to the show.
Thanks for having me, guys. It's good to be here.
It is always good to have you here, man. Always great to talk to you. I know we were catching up a little bit for the show, and it's always a pleasure, man, and really love what you guys are doing. For the listeners who are just tuning in for the first time, who are not very familiar with Invictus, Anthony, full disclosure, I have to go back and look at the exact episode number, but it was about roughly, I guess about a year ago. We had you on the show and had a great conversation and whatnot. So I definitely encourage all of our listeners to go back and tune into that episode. It was great. We'll make sure to put that in the show notes as well. But man, for those maybe tuning in for the first time, again, just kind of give us a brief insight into your background. I know you have a really cool story. So tell us a little bit more about you, and we'll kind of take it from there.
Yeah, I'll try and keep it brief for the sake of people who've maybe listened to the other episode. And it's cool. Like I was just reflecting on this because it has been about a year since we chatted on the podcast last, and like looking at your guys' trajectory and what you guys have accomplished. And then like on our side, a lot can happen in the year, right? Like I think sometimes we like forget if we just keep like putting our nose to the grindstone and putting in the work, like you can go really far in a relatively short period of time. But at the time, you never really feel like you're taking like giant steps. It's always like, oh, are we even moving? Like it's really weird. So it's cool to be here. A little bit about me. The defining characteristic of my life has been that I have ADHD. So I have a hard time staying focused, staying on track. And that was really problematic when I was young. Got fired a lot from a lot of jobs, couldn't go corporate, couldn't work for other people. So I just kind of found myself by default landing in entrepreneurship at a point in my life when I hit rock bottom. Like truthfully, I was like living in the back of a van. My fiance had just left me and I was $80,000 in debt. Life was going really good. It was awesome. But it was actually really easy when you're at rock bottom, you have nowhere to go but up, to throw off the shackles and be like, hey, I'll try something new. And that's what I did when a buddy came to me and he was like, hey, do you want to build a business? And I was like, I don't know anything about building businesses. I've never done that. I'm not very entrepreneurial. I didn't think of myself as entrepreneurial at the time. But again, I had nothing to lose. So I did it and I loved it. I was like, oh my God, building business is a lot of fun. And I think a lot of people maybe like when they're at rock bottom, it's easier to make that transition and like jump into something new than when life is going pretty good, right? Like, and you have a good job and everything is going pretty good. They say good is the enemy of great. And it can be really hard to break those shackles of comfort, right? So I was kind of lucky that I hit that rock bottom and was forced to transition. And, about over the last 15 years, that's what I've been doing, is building businesses. Real estate is just one aspect of that. And it's one that I love the most, honestly, because it's so simple to understand. And it's a vehicle for infinite impact in that everybody has a relationship with real estate, whether you're a renter, you're an owner, you're just walking into a shopping mall, you're an investor, like everybody has some kind of relationship with the buildings all around us. And changing that relationship or making it accessible specifically to our residents so that they can have like an awesome living experience, or to our investors so that they can invest better. Like that's our big mission at Invictus. And I guess what makes us weird or unique is that we're vertically integrated. So we have an in-house property management company, which means that we deal every day with our residents, maintenance requests, leasing, like all the things that go right and wrong on a property. And then we also work with investors to bring them into our deals. And we focus only in the Twin Cities up here in Minnesota. So that's kind of the meandering story of how I got here.
Yeah, no, and so articulate, man. I really appreciate the highlight. And for those again who aren't familiar with your story, Anthony and Invictus, I highly encourage people to go back and look at your bio. I know that you've talked a lot about your struggles early on with your ADHD and how that really impacted you. And like you said, you hit rock bottom. And man, what a cool story of climbing yourself out of that. Really, I think I heard you mention this. You really honed in on it and you really took control of it and you leveraged it as far as a skill set for you now. And it's really propelled you to where you are today. So really powerful story. And you mentioned a lot of great things in your introduction there about, just the impact that we can have with real estate, right? I mean, it probably goes without saying. I mean, most people know this, right? But you have the opportunity to leverage this vertical and this alternative asset class to impact the lives of not only investors, but residents and communities and such. And so just it's a really cool thing to be a part of. I agree. So we talked, let's see, we talked about a year ago. And I think at the time that we talked, I don't know, did you guys go vertically integrated right out of the gate? I don't, y'all did, right?
Yeah, pretty much right out of the gate. So the story is that I started in 2012, 2013, buying assets on my own. And Dan, my partner at Invictus, he started in like 2017. And we joined forces in 2019. But at that point, we had both our own vertical integration operations at that point. So then we just fused them together. I started the vertical integration from day one. Dan tried third party for about 6 months on his first asset and then was like, I hate this. Like, this isn't for me. So then he transitioned. So for a very brief moment in time, he did try the third party and just wasn't working.
Mm-hmm. Yeah, I remember that. And look, there's something to be said about that, because when you talk about building a business, Brian, right? We talk about this all the time, right? We focus on the acquisition pipeline and the process of building a business around, acquisitions, but, taking on a property management company, that's a whole separate business. So you're really creating two businesses at once, and whatnot. So there's a lot of dynamics there, but so you're vertically integrated, right? Almost essentially right out of the gate. I think at the time you were $50 million of assets under management. We were just talking before the show. Fast forward here a year later, you guys are about to put 30 plus million under contract today. So talk to us a little bit more about that. Like what's transpired a year, like you said, over the last 12 months and what's been going on for you guys.
It's been crazy because, for us, we don't focus on like massive assets. We don't focus on 100, 200, 300 unit complexes. Typically, we focus on 20 to 60 unit buildings, and we try to group them geographically. And so our progress has always been a little bit slower and more measured in terms of like the pure number count or the dollar amount of acquisitions that we're doing. Because to your point, like it's so easy to focus on the acquisition pipeline and then forget about the operations. And if you go the third party route, that can be great, like, because you can scale very quickly and you can leverage these experts who this is what they do all day long. And I'm not saying like third party is bad and in-house is good. Like it's all about being self-aware about what your strengths and weaknesses and your unique foibles. Like for us, we're control freaks. And so giving up that and outsourcing it doesn't really work with us. So we had to do the harder route of building the in-house management. And as a result, we have to be really intentional about how many assets we're bringing into the funnel at any given moment, because it's not enough just to close it. We then the next day have to turn around and start operating it, And one of the hardest things for us in this last year, it's been a really great year. Like no doubt we've had a ton of great deals and things have been going very well for us. But the hardest part has been undoubtedly hiring and getting really good talent on the property management side, leasing, repairs and maintenance. Like that great resignation everybody's talking about, the effects of that were real in the last year. Like it was hard getting good people into the door. We're at a really great place now where we have the team in place and they're just firing on all cylinders, and it's awesome. But anytime you're building a business, and like Brian, you could probably attest to this too on the coffee side, like the hardest part of business is always people, whether that's like staff or customers. It's the hardest part. And so if you want to be building in-house management, like just be aware you're taking on a whole new business where all you're doing all day long is putting out fires with people. And one of the hardest things of that is they're people that are living in a home, right? And so it's like this very sacred, important thing to them. And so the level of emotional attachment just goes much, much higher. So all this to say, this year it's been a growing year for sure. A lot of ups, not so many downs, thankfully, even though like the macro market is trying to get really frothy on us. And we've been very measured with the deals that we've been bringing into the pipeline. Specifically, the types of deals that we've been acquiring recently have been just coming from direct to seller, really close relationships with some people that we've bought buildings from in the past. And they're at the point now where like, oh yeah, interest rates are rising, all this headache, I don't want to deal with it. They just want to retire and be done. Like old guys that just want to go to Florida and just be on a beach. And so that's where this portfolio that we're putting into contract today came from, is that, this one old guy who's just like, I want to sell all my buildings to you. And we're like, well, let's take a look and see if we can find a number that makes sense. And sure enough, we managed to do that. So.
Well, and that's the other cool part about the business too. Like you said, it's all people and driven, relationship driven. And, the fact that you've had those relationships before and opening up those doors now, that's the ideal opportunity, right? Is when you have acquisitions coming to your pipeline on that regard, as far as not having to go and be competing against 30 other people on mass marketed deals and, all those things. And so that's really, really cool, man. That's awesome. So, you mentioned, you alluded to the macro economics right now and kind of what you would feel like some headwinds that we're facing against. Let's talk about that, man. Let's talk a little bit more about, you mentioned you're just in the Twin Cities up there in Minneapolis. So we know that markets are different. So what you're seeing or experiencing there may be different from us here in Houston. Let's talk a little bit about, some of those challenges that you're seeing in the marketplace right now and how that's impacted your business, if at all.
For us personally, it hasn't affected us too much because a lot of what we acquired in the past had such great debt terms on it. Like in terms of like rising interest rates, I think the thing to keep in context is that we've been really spoiled for the last 2 years with interest rates in like 2-3%. And so anything above 4 and we're like, oh no, my hair's on fire, this is horrible. And it's like, nah, that's still really, really good. So right now we're finding debt terms in like the low 4.5 interest rate environment. And the Fed is coming out and probably going to do another, 50 basis point hike here in the near future. And that's going to push us up into the 5s. And for a lot of people, that means that the deals that they were looking at, the numbers just aren't going to pencil anymore. And that's the game. Like if the debt is what's making the deal good and making the deal work, it was never a good deal to begin with. And so I think we just need to recalibrate some of our expectations around what makes the deal good. Is it the underlying operations of that asset, or is it the financing that we're able to get the cost of capital so low that now the deal works? Because if it's that second situation, well, when the cost of capital goes up, then the deal doesn't work. And that's problematic. And so in the last couple of years, it's been really easy, I think, for us all to skate by and say, this deal works because the debt's just practically zero, right? And so now we just need to be a little bit more stringent and actually holding ourselves and saying, okay, can the asset achieve these numbers? And that's what you should always be looking for, at least depending on what kind of asset or business plan you're going for. For us, it's value add multifamily with a skew towards stabilized. Like we don't need to be going and getting 25% IRRs. We're happy all day long doing 18-20 with low risk, trying to mitigate that downside and let the upside take care of itself. Like we'll hit those 18 and 20s all day long, assuming that there's really healthy reserves and the ability to absorb a lot of shock. So like, as we're seeing interest rates go up, like it hasn't really affected our model too much. But I think for a lot of people, the numbers aren't going to work on deals that maybe in the past they would have. And so one thing I think that you should be considering is that how long will the interest rates continue to go up and like how high will they go? And a lot of the chatter that I've been seeing is the Fed is probably going to overshoot this. And the interest rates are probably going to come back down, right? Like they're going to overshoot because this is typically what they do is they overshoot it and then it corrects and comes back down a bit. And so right now might not be the best time to lock in like super long-term interest rates. It might be okay right now to get, like a 10-year term, but with like a 3-year reset. Like in 3 years, I don't know what's going to happen, but I can't imagine that the interest rates are going to continue rising to the sky unless, something crazy happens. Inflation just goes rampant. But That's kind of what we're seeing right now, at least. I'd be curious, what are you guys seeing on your end? Are you experiencing the same thing as you're looking at deals and trying to underwrite for them? And like, is it getting harder?
Yes, it is. We do subscribe to the very similar thesis as you. It is getting substantially harder because, you've seen the aggressive asset value acceleration, right? Assets that we were looking at 12, 24 months ago that are now 30 to 40% higher in value today because, like you said, cost of debt is so cheap, right? And that has been part of the driver in addition to the demand, right? The supply demand dislocation. Everybody's well aware of our housing shortage. And so, but it has become more challenging because now, you could, especially if you're looking at variable rate debt, you could really bank on the fact that, okay, I have at least 12, 18 months of relatively low interest rate environment, less volatility. And I'm comparing this to last year, right? The same conversation last year. We didn't have the volatility in the markets like we do now, right? Where now every month we're like, okay, here's another 50 basis points. Here's another 50 basis points. Here's another 50 basis points. And not only that, our rate cap costs, our rate cap costs are just astronomical right now, which is also impacting deal. So it is becoming a challenge, yes. And I don't disagree with your point about the debt. And if the debt doesn't work, then or if the debt made the deal a good deal, then it probably wasn't a good deal. I don't necessarily disagree with that, but I think that's just one variable, right? There's multiple variables that you have to look at when you're making that assessment. But I still think at the end of the day, the fundamentals are still very positive, across multifamily in general, across the country in general, various markets. And that's what we're seeing is you're not seeing, we're not seeing any deviation from the aggressiveness in the marketplace yet, because of the demand for the product, the demand for the vertical, the demand for the yield, and the inflationary hedge, right? And that's the other thing too, is I think to your point about the Fed and what they're trying to do with getting inflation under control, they can try to pull as many levers as they can, but I don't see a realistic circumstance where they're really going to be able to tighten up inflation using just only interest rate hikes. Because there are issues that you just can't fix with that, right? You can't fix supply chain interruptions. You can't fix the fact that China is going back into a lockdown scenario. And all of I think there are millions of people that are now in self-quarantine again. That impacts the global economic distribution chain. And so you can break hikes to the moon, but it's not going to fix that. So I'm sorry, I'm going off on a tangent here, but
no, it's really good stuff. I want to dive into this deeper because, and real quickly, like the clarifier about debt making a deal, or breaking a deal is that debt can make a good deal great, but the debt can never make a marginal deal into a good deal. Like if it's a marginal deal before the debt is applied, it's going to be a marginal deal even after. And so the baseline needs to be, you have a good deal. And the debt structure can make that good deal look really damn good, right? Like we could take it from good to great, but not the other way. We can't make it from poor to good. So just be aware. I think that's the key. And then in the terms of the valuations, what's so interesting is like as interest rates are going up, historically, there's been the thesis that interest rates and cap rates are correlated so that as interest rates go up, the cap rates will also go up and that the valuations will, as a result, drop. And it makes sense because if the cost of capital is increasing, then the amount that I can afford to pay for an asset is going to go down. But that's not happening. And we're not seeing that at the moment. And I think Peter Lindemann talks about the fact that instead of thinking about cap rates and interest rates being correlated, think about liquidity and cap rates. And the reason that cap rates are continuing to compress and valuations are continuing to increase is there's still a ton of liquidity in the market. Like in the last 2 years, we've just printed so much money. There's so much money out there trying to find a place to get yield. And when it comes to like the opportunity cost, like what's the highest and best use of my capital right now in an inflationary market, even with rising interest rates on real estate is still the best hedge. Like the stock market is still subject to all the same factors, right? But to a much greater degree. So I think when it comes to, are we going to see valuations suddenly like revert and plummet because we're just spending too much? I don't see it. Because fundamentally, it's a supply demand question. We're about 4 to 5 million housing units short in the US to fill the current need. And we're not going to be able to fill that in the next 5 years. There's no way, given where labor and materials and supply chain and everything happening in the world, we're just not going to be able to fill that. So there's going to be continued demand and high demand for a very fixed amount of supply. And we're going to see valuations, I think, and my crystal ball is not very good, so don't hold me to this, but my gut tells me that values are going to continue to increase as the supply becomes scarcer and scarcer and thus more valuable.
I absolutely completely agree. And Brian, I know we were just having a lot of this conversation here recently, right?
Yeah, I think, we get so caught up in the X's and O's sometimes as investors. We get analysis paralysis. We want to overanalyze, I'll use that term, everything, every part of our Excel model we want to dive deep into, which is good. We want to do due diligence. But sometimes you just have to think about the real estate fundamentals, right? Where's the property located? Does it have a great story? Are you in a market that has really high demand? And then what's going on in that market? Houston, 2021, 16+% rent growth, right? We're seeing double-digit rent growth again this year. A lot of net migratory patterns to Houston, a lot of great job growth. Then we've got this rising interest rate environment, but you're still essentially getting free money. If you're getting 7 or 8% on your CPI and on your inflation, and you're borrowing money at 4.5 or 5%, you're still negative if you take the broad picture stroke of it. So there's a lot of great things going on in real estate, and I think we're all singing the same tune. We're all still very bullish, even though some people are standing on the sidelines, which is okay with us because that makes it more opportunistic for somebody like us who understands really what's going on in the market. We're going to go out there and be responsibly aggressive according to our investing thesis and go out there and try to find some good deals.
Yeah. If you're sitting on the sidelines right now, waiting for the right moment, I can just guarantee that you're going to be on the sidelines forever because it's never going to look like the right moment. Right now, at this point, with rising interest rates, we're going to say it doesn't look like the right moment. You go back 2 years, we're all in lockdown at this time of the year. We just went into quarantine 2 years ago at this time. It's not the right time to buy. You go back 2 years before that, and everybody's like, oh, recession's coming. We can't keep growing to the moon here, right? And so you're sitting out then as well. Like, you can always find a reason to sit out. But the thing is, like, real estate's one of those things that you don't just wait to buy, you buy, then wait. And if you do that on a long enough time frame, you're going to do okay, assuming that you bought on good fundamentals, that you gave yourself a buffer and you have enough in reserve and you have, operational skill. So like the only way to get that is by doing that or partnering. And so get in the game, because you're going to, is by sitting out of the game, you're going to lose regardless. So you might as well get in there and start making some shots and at least give it a go.
Yeah. Anthony, well, that's so good. I'm so glad you brought this up. You made so many good points here. And this is the exact same thing that has been taught to us and preached to us from people that we have a tremendous amount of respect for. We referenced our story about meeting Grant Cardone in a mastermind at the end of last year. And he said the same exact thing. Listen, the most money you guys will lose on the deals that you haven't done, right? You have to own the real estate. And this is a message that we've also been preaching to people here as of late, is we have to remember, I think when we talk about syndication and multifamily, I mean, we've seen the amount of wealth that's been created over the past decade with guys that have been transacting, buying deals and exiting in 2 years with 2 to 3x multiples. And hey, life is great. Everything's awesome. But you have to remember that's not typical real estate. That's not where really wealth is built, right? And so we all know, to your point, is like, listen, you have to go into the mindset of really, like you said, you have to buy real estate and wait, hold it long-term, plan to execute long-term. And that's where you're really going to capitalize on opportunity. And I think if you can remember that wealth is built in real estate long-term, then not to say that sticker price doesn't matter or purchase price doesn't matter, because it does. You definitely don't want to overpay for an asset that is not a good asset. But at the same time, if you're well capitalized, if you have a good business plan, you have a good story, and you can hold long-term, that's where your payoff is going to be much higher. So
yeah, you said something there that I think is so important, which is recognized in the last 5-10 years, it's been really easy to get that 2-3x multiple in 2-3 years. And as a result, I think a lot of us have very skewed expectations of what are realistic returns. And so I think right now, as we're just in this not frothy, but we're in this uncertain environment, the first thing I encourage everybody to do across the board, lower your return expectations. just lower your return expectations and lengthen your time horizon. Do those two things, and you're probably going to come out the other side. At minimum, you're going to be not disappointed. So like for so many people in the last couple of years, it's like 25% IRR in 2 years. And it's like, how about 18% over the next 10 years? That sounds pretty good. Let's do that. Like, or maybe 15% over the next 10 years. Like, that's still pretty darn good, guys. Like, it's just been so easy to like look at 20% IRR and like any deal that doesn't hit that threshold, it must be a bad deal. And it's like, no, guys and gals, like they're 14, 15, 16% IRR, given like what you could realistically put that capital into elsewhere and get like a similar risk adjusted return. Like you just couldn't do it. So just let's try to recalibrate our expectations a bit.
Yeah, that's such a great point. That's something that we're very big on right now, and really coaching and educating. I say coaching, educating, but really kind of preparing our investors for the same, right? Is because you're absolutely right. The market is giving us what it's giving us, right? The days of those high yield, high IRRs, high cash on cash. I mean, depending on what market you're in, they're just not here right now. And so you do have to adjust your expectations, both from an active investor and as a passive investor. I mean, we all understand that, yes, we want to maximize returns, but I mean, right now, just this market is not delivering those returns. But at the end of the day, to your point about risk adjusted basis, it's still one of the best asset classes to be in. And if you're getting to real estate with the right approach, I mean, who's going to complain about, a 6 to 7% cash on cash, or like you said, a 15% IRR? I mean, if you really should not be dissatisfied with that by any means. So
yeah. You mentioned something before with Grant Cardone that I think is really cool. Is the concept of the anti-portfolio. Is like all of not those deals that you have done and what those assets that you have in the portfolio and how they're performing. I want you to look at all those deals that you've passed on and look at those and say, how much did I leave on the table? And if you calculate that, if like I was thinking about this deal, I passed on it, but then keep a tab on it. Pay attention over the years and then calculate it. I think most people, their anti-portfolio would be so far in the black that it would make them blush. They'd be like, oh my God, I'm an idiot for passing on all of these deals. That's not to say like you should just go jump into all these deals, but just recognize like it's so easy to ignore the potential gains that we passed on, because once we pass on it, we kind of shut our mind's eye to it. But then it makes it really hard to, I think, objectively evaluate the quality of the decision that we made in that moment if we aren't also tracking the result. And so it's very easy to pass on a deal and just say, oh, I made a good decision. But did you? I don't know. Like it's easier when you say, I'm going to invest in this deal and it doesn't work out. And you can say that was a bad decision, or it did work out and that was a good decision, right? So I just generally, I think the idea of an anti-portfolio is super cool.
Yeah, I agree. And I'm going to make a comment here that may not sit well for a lot of people, but look, this is the one I feel like missed opportunity for education programs right now that are out in the mass market. I would argue that most people are probably involved in some type of mentorship program. They want to learn how to do this business, so they're coming into educational mentorships. And the one thing that I feel like you don't hear a lot of coaching or teaching being done at is looking at really the underlying fundamentals of macroeconomics and how that's impacting us as real estate investors, right? You can't just read a headline and say, like you said, oh, interest rates are rising to the moon. Oh my God, debt's going to be, super expensive. Now we can't go buy deals. And you have to really look at, man, like what are the experienced operators doing? Why are the guys like, your Grant Cardones and your Michael Beckers, and like none of these guys slowed down during the pandemic. They didn't stop buying deals. Nobody's stopping buying deals right now just because the Fed is raising rates. I mean, like really you got to pay attention to, these more sophisticated shops and operations and how they're buying deals and why they're buying deals the way they are. And it's because of this conversation here is they're looking at the underlying fundamentals that are really driving the demand for the space. And that's where I feel like education programs are really missing out right now and being able to educate their students and their mentees on just that principle. Because I mean, Anthony, I know you're a coach, right? You talk to a lot of students, and I'm sure you get this question often about some of these very things that we're discussing. Well, how can I go buy a deal if rates are 6%? Well, shoot, 2 years ago, that was great. You know, I mean,
Yeah,
6% was great. You know, who was complaining? So
yeah.
it sounds very
It's
rudimentary, but I think right now is the most important time to really understand, you know, economics, macroeconomics, and how that impacts us as business owners.
I would 100% agree. I think the education programs, they tend to focus on tactics and not so much the strategy.
Yeah.
And the strategy is informed by a higher level theoretical understanding of all the variables at play. And in fairness to the education programs, it's really hard to teach that to most people, because most people just want to get in, they want to learn how to do the thing and start taking action. And then like the time horizon that they have is so short. And so there's a little bit of that, but then there's also another caveat, which is in a lot of education programs, I don't think that a lot of the people teaching have put a lot of thought into this.
Mm-hmm.
They have been doing the thing that they do and it works. And so they're teaching others how to do the thing that they've done that works. And without really, really understanding and popping the hood and taking apart the car to see like, why does this work? Why has it been working? Because a lot of education programs are teaching, and like we're part of, you know, Jake and Gina, and I'll be transparent here too. Like, and Bill Hamm and I've talked about this, and it's like the value add multifamily model that worked over the last 10 years doesn't really work in the same way anymore. Right. So what worked over the last decade is not working in the same way moving forward. And so we have to be able to adjust our tactics accordingly, but that's only informed by our understanding of the overlying strategy. So I totally agree with your point. And the way to do that is having as broad and deep an understanding as possible of the macroeconomic environment.
Mm-hmm. That's a really good point,
Cody.
Oh, go ahead, Brian. Go ahead.
No, I was going to say he's definitely speaking our tune. I think that's really important. And I love the way you categorize it, Anthony, talking strategy versus tactics, because, you know, as young entrepreneurs or young investors, when we get into these programs, we just want to be shown like, give me the recipe. What is the recipe? How do I bake this pie, so to speak, and really become successful? And as the chef, as the coach, we have this recipe that has worked for us for 5-10 years, which is why we've gotten into a position where we can be coaching people. But what you fail to realize is, you know, that recipe doesn't necessarily work anymore for the novice investor with no track record, low liquidity, a low amount of relationships in the business, and they just don't have everything that person has. So to go and try to apply that tactic for somebody who's freshly entering the industry, it just doesn't work. And I think this conversation is super important. It's something for everybody to consider, is what tactic am I applying to my business versus what's actually going on in the market. So I think you did a great job articulating that, Anthony. And Cody and I talk about this all the time. It's a great conversation.
Yeah. And you know, Anthony, you to highlight what you said, it's like, look, the industry's not static. You know, it's evolving. It's ever changing, and the real estate itself may look the same, but like you said, the strategy may be different. I mean, if you look at entry into multifamily right now in today's time, you're entering into a very dynamic marketplace that was very different 3 years ago, 5 years ago, 10 years ago. You know, there's much more moving parts and different levers that are impacting your business today that you may not be facing in a different market cycle. So yeah, the idea that there's a static strategy or tactic is where a lot of guys are going to be challenged with, because you're right, it's evolving, it's ever evolving. You have to always be innovating and constantly learning how to be creative, right? I mean, not only being creative in adding value to your properties and your communities, but, you know, being creative in, you know, how you go about acquiring these assets. How do you go about structuring the debt? How do you structure the equity? How do you, I don't know, just like you said, how do you apply the drivers of our economics today into our business and make sound investment decisions that can be long lasting, that you can continue to scale your portfolio with? So love this conversation, man. It's good stuff.
Yeah, I love it too. One of the first questions I ask every student that I work with on the first call I have is, I want to be really clear. Are you looking to invest in real estate, or are you looking to build a real estate investing business? And what we're talking about here is for the people that want to build a real estate investing business. If you want to invest in real estate and you're hearing this conversation, you're like, oh my God, I don't have time for all that. Like, cool. Then you should be investing in real estate or in a group like, you know, Blue Oak Capital that goes out and does all this, right? Is doing all the work and doing all the research and staying on top of it. Most people don't have the interest in doing that. And what I find is when I break it down in that way on that first call, a lot of people go, actually, I just want to invest in real estate. I'm like, cool, that changes the trajectory of this conversation entirely, because what you need to do versus what somebody who wants to build a business around this needs to do is completely different. Doesn't mean it's easier, but it's completely different.
Yeah, such a great point. It's so easy to focus on the real estate, but we're not talking about the real estate. We're talking about the infrastructure of a business, scaling a scalable business that's sustainable. And I completely agree with you. And that's where you see a lot of guys that come into the space, and unfortunately they get weeded out because they think that this is the way they want to go. And they get in, they realize, oh my God, not only this is a ton of work, but there's so much more to it than just, oh, I'm going to go buy that deal today. There's so many moving pieces and so many variables to that. And unfortunately people get weeded out, but just great. And I love that approach, by the way. I mean, you got to kind of call it for what it is up front and save people a lot of time and a lot of wasted effort and headache, and really help them develop their investing strategy from the beginning. So that way they don't get frustrated and whatnot. But anyway, man, good stuff. So, all right, Anthony, well, look, tell us, you mentioned you guys are acquiring a big portfolio today, fingers crossed. By the time this recording goes out next week, you'll hopefully have, be working towards your contract, but what's on the horizon for 2022 for you guys?
Yeah, honestly, that portfolio is going to be a big time suck for us, bringing it in and then operating it and getting it up and running, getting the team, comfortable with the assets and just running it effectively. Like that's the hardest part of any deal that is so often easy to gloss over. So that's probably going to be the primary focus of the rest of this year. Just keep rinsing and repeating. And that's the thing for us is like, I really like multifamily investing. I like our business model. I just want to keep doing more of it because the more we do it, the less risky it becomes because the better we get at it, the more efficiencies we get. So it's boring for some people. And they're like, oh, now that we have some stability here, let's start turning our sights and looking at something else. I'm like, nah, let's just keep doing the same thing over and over and over and over. So that's what we're going to do this year is just keep doing the same thing over and over and over.
Hey, if it works, don't fix it. If it's not broken, don't fix it. Right. So
exactly. I like boring investing.
I think most savvy, sophisticated investors would absolutely agree with that as well. And I think we're definitely in that bucket as well. So, well, Brian, anything for Anthony before we jump off here?
No, definitely appreciate Anthony articulating a lot of his opinions and thoughts about where we're at in the market cycle, what they have going on over at Invictus, and all the factors that are both active and passive, whether you're in the market or potentially looking to enter the market, what they need to be thinking about right now, because real estate is not black and white. It's not good deal, bad deal. There's so many other elements moving behind the scenes. The more knowledge you have, the more power you have, the better decisions you can make. So continuing to educate yourself, whether it's listening to podcasts like this, watching YouTube videos, going to Meetup, reading great books like Anthony and Dan have, that's going to make you sharper so that when you go into investing into multifamily real estate, you know which trajectory you're on. Are you trying to build a business or are you simply trying to invest? If you're trying to invest, build trust with quality operators, with people like Anthony and Dan, hopefully people like us as well over at Blue Oak. And we're going to go out there and we're going to make sure our pencil's super sharp. So we're trying to find great opportunities that are risk adjusted for long-term wealth building. So definitely appreciate you coming on and singing the same song we're singing, because I think we're all bullish on the market right now.
Absolutely.
Yeah, it was fun being part of this choir.
No, it was great, man. And we love these conversations, right? Because there's no script, there's no predetermined questions or conversation. And this is where you really get great organic nuggets that really are applicable to your business. So Anthony, always appreciate the opportunity to spend time with you, man, and the great insights. Hey man, tell listeners how they can learn more about you over at Invictus and get connected with you.
Yeah. So if you guys are interested in what we do, go to Invictus Multifamily, check that out. But the thing is, like we mentioned, we wrote a book last year about passive investing and making it simple. It's really designed for people that want to be passive investors. If you guys are listening to this and you want a free copy of the book, I'll make a very special offer here, which is you got to go leave a review for this podcast on iTunes or wherever. Go leave that review and then shoot me an email at anthony@invictusmultifamily.com and say, hey, I left a review. Now give me my book and I'll send you a free copy of the book. And this book has like been in the top 10 on commercial real estate for like the last 8 months. So it might suck, but it doesn't suck a ton. So there you go.
Well, I'll tell you, it doesn't suck at all, man. It's a fantastic book. Everybody, please make sure to go check that out. Anthony, thanks again, man. Appreciate it. Look forward to the next one.
Anthony.